Indiacharts publishes Nifty daily video updates, the weekly Elliott wave outlook, and the long-short report covering all asset classes.
I just wanted to do a quick update on why I'm talking about a small bounce or maybe an X-wave higher degree. Apart from sentiment readings, the comparison with the US market, because while I do still think the US market is in a larger third wave down, which means we've taken this as A, this is the Nasdaq Composite, taken this as B. This has already happened, and we've already started C down, where we are marking 1 of C, 2 of C, and we're in the early stages of starting 3 of C. Now, what happened when 3 of C actually occurred, when this fall was occurring, this is where recognition happens that yes, this is actually going into a deeper bear market. At this point of time, the Indian market, for whatever seasonal factors, it got a little oversold here, which is October, and October to Feb was a seasonally bullish period back then. And so when I took a call in October that year that you'd bounce for a couple of months, what the surprise to me was that while that view was purely based on the Indian market, I used to pay less attention to the US. It worked out with a divergence to the US market itself. And the only reason this happens is that you have global factors at play, but at the same time domestically, because the index itself, Nifty, Sensex, had more of the domestic components, not the tech stocks. They were finding attractive buying interest at lower levels, and so probably that was behind, and there was a lot of volume. So after this sell-off, you actually saw huge volume during this phase. And what I explained in the long short webinar, that largest decline phase in those nonsensical stocks, if I may call them, occurred actually occurred after this point. So we probably not reached that point. It looked like we are starting wave Y down, but we got a little oversold on the key indices, and which is why I'm starting to consider maybe that happens a little later. And in the interim, you get a counter trend. And can we really? So what I'm trying to show you here is, can we really diverge? It's very, very hard to digest. Back then, probably because of my focus only on India, I was able to hang on to it more easily. But if you look at it, if you get such a divergence, you would probably not be able to stick to a view that you're going to bounce in the face of a sell-off in the US indices. So that's the tricky part. And so if I bring this to the current situation, this is where we are. You have seen even so far, that Indian markets have actually bounced harder or fallen harder at some points of time. So here we actually fell harder than the US market and bounced pretty sharp. Okay, this fall we have sort of this rise we have sort of coincided. But if you look at the size of this decline so far, we have fallen less. And now what I'm saying is, okay, this is only going to do a minor 2 of C, 3. It's going to try and continue lower. This is what I am thinking. After it will bounce a bit, but the structure says it's supposed to continue. Okay, in our case, I'm just wondering if we do the same, which means first of all, you can do a retracement to this gap area, or 61%, which I've already opened up to, which is 15,888, or 61% is closer to 16,000, which is also the 20-day average. So this much. Now this much would be similar in line with what the US is doing. But can we do more, because we are sentimentally reached a very, very extreme? Can we do 61% of this entire fall? And that can then last through the earnings season in July, and then you see the next leg down in August. This is a second alternate, and I'll not be able to say 100% this is happening, but the extremes in sentiment definitely indicate that, when you look at FII shorts reaching 142,000 contracts, which is the highest since the last time it made a medium-term bottom. And those kind of data points are indicative it needs a little more cooling off than we've really seen. Another one is actually this is the 40-day advanced decline ratio of all listed stocks on the BSE. I take BSE because it has a larger basket of 3,000 listed companies, and most of them are common between the two. So just to get a broader basket, and when you see this, what you'll actually note is that all the extreme oversold readings that have occurred are below this red line that I've drawn over here. So it's all the way down here. These are the extreme readings. The midway readings are here. Okay, so the readings that occur close to the red line are mostly corrections within a bull market. Okay, the bear market corrections have all been far deep. So they have all gone down here till around the 31 mark. And during a bear market, you can get several such readings like this one. So each one leads to a bear market rally, then another sell off to extreme oversold, then bear market rally. This is what we noticed in 2008. Even in 2000, I think this extreme was reached only after this point which we were just talking about, where the major selling occurred. So now we are sort of entering that phase. We've entered this extreme low reading. See, even in 2020, we got it twice here, and here we have extreme, data readings. And wait, this one is not, sorry, this is only a parallel line. So let me just, so yeah, now that I've just removed that. So yeah, this is the only one which is in the pandemic, you got a single reading. But because that was not a continuous 2-year kind of bear market like 2008 or 2000, we didn't get multiple such readings. Here you got 2, here you got, 3. Okay. So here I think this is just the first. And you know what happens after you get the first and the market attempts a pullback is what I would expect as in 08 and X wave. So an X wave usually means a retracement of the last leg, and then the subsequent leg again you will fall to another extreme oversold reading in the next leg down. So what lies in between is the potential for a slightly bigger bounce than I would have usually thought, purely based on what our data, the Indian data, is looking like. And sort of that's the sentiment I see expressed even in the media, which is very rare after a long time. Almost everybody being interviewed is sounding caution, who are typically the perma bullish, because they're always saying, hang on, there's always value to be found. People who are backing off and saying it's time to be careful. Most of them, a much larger number, I've heard one after the other saying the same thing, which is sort of the sentiment that is reflected in these other data points. See, I don't go by individual people saying something, but if it's in the data, if we have certain extreme sentiment data, then it probably reflects what is happening there. So the point here is, while we can go to 16,000, it's also possible that initially you bounce, you do that, and then you do see some selling from there, which ends up being A, B, and then B retraces 61%. So either it goes straight up, completes the bounce very quickly and rolls over, or the second case is it will do B, because of course you have continuous selling in the US, so there will be pressure. But eventually you might complete a C as well, which means A, B, and C before you are completely done, and then get ready for another leg down. So in that light, then if I go to what we are really seeing here in the Nifty is that if we do a larger retracement of this entire fall, and I look for, say, 50% comes at 16,650. I wouldn't expect 61, but that's at 16, almost end up being 17,000. So 50% or a little higher, which is close to this previous high, being retested opens up 16,600, 700, 800. If we are going into a larger X wave, and how will we know that is happening? Well, we'll navigate it. See, throughout these rallies, you noticed how we navigated. This is, if you could see a 3 waves up, you give up from there anyway. Even here, I was waiting for, maybe we'll do 61% retracement, which was slightly higher up here. It didn't happen. It just came to here, the 20-day, in 3 waves and started to break down. Moment I see that, I'll probably turn anyway. The same thing happened here. I was waiting for maybe a slightly higher level. And moment it gave me this red bar, it looked like we've truncated Z and we've rolled over. So if we see something like that, we probably take that as a cue. I've already mentioned this initial resistance near the 20-day is going to act as a resistance. So you may see a pullback from there. But if we can clearly see this as 5 waves up, then I'll most probably mark it as A. That will then make it more obvious. So we'll watch that evidence as it goes along. If it gives us signs that, yeah, there's only A and B, then I will anticipate that C up is happening, and C up will end up being that larger retracement. Now, if it does this larger kind of thing, we will consume into sometime into July, which is the earnings season, before we can actually complete the X wave. If it's a small bounce and go, then within a week it's over, right? It doesn't last that long. So by sometime within 1 week, you'll have completed a smaller degree bounce will be over in 1 week. But if it's a larger one, then you can give it 2 to 3 weeks at least to really complete, just like this last move over here, which ended up taking 2 to 3 weeks. So moving to, this last chart, which is the 20-day AD ratio, you see this small positive divergence Of course, it requires to be confirmed. Yesterday we did get a positive close, so as long as that low holds, this is going to look like a positive divergence here, where the 20-day AD made a lower reading on the last bottom end of wave A, and wave C has a which is a lower bottom, has a higher reading on the 20-day AD. So that's a slight positive divergence. Now, one last thing which people might again ask is, but isn't this short? Okay, if we see that this is ABC, so it is going to be short. So here's a clean chart so that you can see it, and what essentially will end up being the case here is that C, in this case, which is here to here, will be 61% of wave A. Okay, not your typical setup, but it is very, very much possible that an ABC decline occurs where C is short. I mean, it's not completely out of the woods. It is normal, and so not something that you should get worried about, that oh, C is short, therefore it may not be complete. It can be, and therefore if it is complete, then the potential for an X wave is open, which is a 50 to 60% retracement of the entire ABC basically. Then, so some people ask, what is this labeling? How will we label it? If I end up saying this is 5 and this is W and X, what this means is that wave Y is getting complex. Okay, so wave Y becoming complex means this ABC X is just the first W inside wave Y. So wave Y itself might end up being a complex triple zigzag. That is one way of looking at it. If I go with the earlier count that no, phi ended here, we were in Z, then it could be Z getting complex. So something getting complex over here, and this is all, the reason for all this to happen is essentially rotation. Different sectors bottoming out at different times, topping out at different times, creating divergences in the wave count is causing the index to show these kind of, structures, and we just have to take note of it. So similarly, if you do even get this bigger X, is it every sector that's going to move up that much? The answer may be no. It may be varied. It may be differ from, there where you have seen big declines, like maybe a wave C in the small cap or big sell off in metals, those could see larger B waves. Others which have done an ABC correction may see only a X wave retracement, and so there's going to be variation from sector to sector also. You cannot expect all of them to behave in the same way. And even though I'm saying metals, it could be that ends up being a smaller retracement given the negative sentiment. There may be something else does it. So figuring that out, what will do better than what might be a more difficult call. What we'll try to though figure out is whether we can get this kind of a structure which can even diverge from the US a little bit in the short term, and then align with it at a later point of time. Will that happen is the question of the day. We do have the extreme sentiment readings required at this point for something like this, and that is why I am putting it under consideration. Of course, we'll monitor the smaller legs inside this whole pattern and watch for an actual trend reversal before we say that it's headed down again. So that's the main point here, because it's usually good. I mean, before another big sell-off happens, you'd want indicators to go up a lot more than where they are right now. Say for example, if I just plot the RSI, okay, the relative strength index onto the chart, then what ends up happening? Okay, sorry, that's in green, make it black. Is that see both the previous highs from where the index sold off, you had readings of almost 70 over here, or somewhere between 60 and 70. That is typical. Above 50, before 70. This is a lower reading. It's similar to what you saw say over here. So you'd really want a lot of space to get created in terms of the reading. That's only possible if you get a bigger X, and then you have a lot more room to go down before you can say it's oversold again. So that's, I think, sort of what it is. It can also be that you end up here. Now, only a small little bounce from here to here to 16,000 may not get you up here. Okay. But of course, nothing to say you cannot go down. Okay. I'm just saying that the extreme readings suggest that we should be open to the possibility. If it happens, we shouldn't, get caught up in it. That's the only thing that I want to mention here. And so we'll be a little more careful, watching for a clear sign that the next leg down has started before jumping onto it.